Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about what's next for the S&P 500. So this is the latest in our Choose Your Own Adventure style video where we take a look at a particular asset class like the S&P 500, the NASDAQ, gold, Bitcoin, and think about what may come next. Now, this is what a lot of investors do a lot of the time, but with this particular exercise, it's based on what's called a probabilistic analysis. As an institutional investor, when they describe what they think may happen, that is sort of their most probabilistic outcome, meaning they think, based on the weight of the evidence, this is what's most likely to happen. But you also want to think about alternative scenarios. What would happen if the market would go up a lot further than you'd expect? What would happen if it would go down a lot further than you would expect? What would happen if it's somewhere in the middle? By forcing ourselves to think about outcomes that are outside of our sort of predetermined narrative, it just helps us to be less surprised when something unusual happens. And as you probably know, unusual things happen way more often than you might expect when we're talking about the financial markets. Today we're going to revisit the Choose Your Own Adventure discussion that we had 3 months ago in June. We'll look at the chart that we shared, look at the 4 scenarios, talk about what scenario actually played out. Then we will look forward at 4 potential scenarios starting now in September 2023. I would love to know which of these 4 scenarios do you see as the most likely and why? The very bullish scenario, the mildly bullish scenario, the mildly bearish scenario, or the super bearish scenario. Make sure you vote below and leave a comment explaining what drives that decision. Before we get to the chart, make sure you like the video if you wouldn't mind. We'd so appreciate it. Make sure you subscribe to our channel as well. That would help us out a great deal. And before we get to the chart, here's one more thing to think about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. So this is the chart we actually used back in June of 2023, June 9th to be precise. When we posted our video, we laid out the S&P 500 with 4 different scenarios. Now this is when, if you can rewind mentally a couple months ago in early June, we'd had a pretty good rally. We'd come off of the October 22 low. The S&P and the NASDAQ rallied nicely. December pulled back, but then January kind of lights out to the upside. Brief pullback in February, kind of a time correction here in April, but overall, it was really feeling like off to the races here into early June. We were retesting the 4,300 level. We'd already broken through 4,200, which was the February high. Now we're testing the August 2022 high around 4,300. We posed 4 different scenarios. Did you vote for scenario number 2? Based on what we saw over the subsequent 6 to 8 weeks, I would probably declare scenario 2 most closely related to the actual performance. If you look, soon after we posted our video, we had a nice move higher, a brief pullback, and then there's this nice consistent pattern of higher highs and higher lows. And for the 6 weeks after our video was posted, we continue to push higher. What I did not realize is that 6 to 8 week window would put us right around where the market stalled out, right? The S&P topped out around 4,600, and that line was a key one we talked about. That was differentiating scenario 1, the very bullish scenario, which was a break above 4,600, to scenario number 2, which would be between 43 and 4,600. So if you voted scenario 2 last time, nice job. That was pretty closely tied into what actually happened. Now let's think about going forward. Now what do we do? Well, we've had a pullback, of course, in August, beginning of August, the second half of August, bouncing back to the upside and almost closing the gap back to the August peak or the July peak, but not quite getting it done. Here in early September, after the Labor Day holiday, we've rolled off a little bit. Some of the growth leadership names like Apple and others have pulled back a bit. And now the big question mark is what comes next as we're in the seasonally weakest part of the year, August into September. Here, is our new set of 4 scenarios. This is where the S&P is today. I've brought in a little more data just because if we would recover, the chances of us getting back to a new all-time high is certainly a possibility. So I wanted to include that as one of the possible scenarios. Here are the 4 that I would lay out for you. And again, this is not a precise exercise. It's more to force you outside of your comfort zone, certainly force you outside of your narrative, whatever you think is going to happen or should happen, and think about what could happen. And that's really the point of this probabilistic analysis. So here are the 4 scenarios. What I would love for you to do, I will explain each of the 4 scenarios. I'll give you some background in terms of what could actually cause that to happen. And then what I'd love for you to think about is how would your portfolio actually perform in each of those 4 scenarios? Which one do you see as the most likely and why? And again, vote in the comments section below. Tell me which one and why. And then also think about the other 3, though, and make sure you recognize or appreciate what could happen to your portfolio, to your risk appetite, to all these other things if those different scenarios would play out. That's how you're going to be less surprised regardless of what happens next. So, scenario number 1, the very bullish scenario. In this scenario, this pullback, this sort of wave 1 down or wave A down off of the August high is short-lived. This bounce that we saw in late August and this brief pullback is part of this further recovery. We've seen energy stocks breaking out over the last month or so. The growthy stuff like Nvidia and Apple and Microsoft and Amazon recover. They had a bit of a pullback. They now recap or regain those losses and much more. Scenario number 1, the very bullish scenario, I think gets us above 4,600. I would say 6 to 8 weeks from now, as we get to late October, we're talking about new all-time highs. And I would say whether we get there and get above 4,800 or not is less meaningful, but more that 6 to 8 weeks from now, we will be talking about the fact that new highs are in play, and that's the new question. It's not whether we're going to get up in that range. We've done it. It's going to be what comes next. So the very bullish scenario would have to mean the growthy stuff that is starting to take a breather. The breather's pretty much done, and very quickly they start to recover and everything starts to come up. Higher rates are going to have to either be a non-factor, meaning the market rallies in the face of rising rates, or interest rates would have to start to come down quite a bit to give room for growth sectors like technology and consumer discretionary to thrive. So that's scenario 1. The very bullish scenario involves a pretty quick recovery, building on what we've seen so far in the last couple weeks. Scenario number 2, what I call the mildly bullish scenario. What this means is we're still in a pullback phase, but it ends up being more of a time correction than a price correction. What you have to remember when you look at market history, there are 2 different ways that a market can correct. In price, meaning it pulls back in terms of absolute value, or time, meaning it just the duration correction, meaning it just takes a little bit of time. It's a pause, right? You hit the pause button and then you hit play again and it resumes its uptrend. If you look back on the chart of the S&P 500, you can see perfect examples of both of those, right? February, March of this year was what I would call a price correction. It took about 6 weeks, but it was more about the price, right? The pullback to retest the lows from December. If you look here in April and May, I would call that a corrective phase as well, but it was more of a time correction. We really didn't lose any ground. We chopped around a little bit, but it was more about the market rallying in March, and then April, May were kind of sideways, and then late May into June is when we resumed the uptrend. So scenario 2 would have to be kind of more one of those time corrections. We wouldn't really give up much ground, and I would say we'd sort of remain in that 4,300 to 4,600 range. We would not get above the July high, so that's a key separation between the bullish, very bullish scenario number 1 and the mildly bullish scenario number 2. Scenario 2 basically means we don't lose a lot more ground. We probably hold 4,300, but we don't get above 4,600. In 6 to 8 weeks, we're still kind of chopping around. Now, what you have to remember in scenario number 2, there could be a lot of movement. Energy stocks could go up another 5-10%. Growth stocks could actually come off a little bit. Defensive sectors could continue to underperform, like utilities and real estate. But at the end of the day, all of those movements net out to major benchmarks that aren't moving around that much. That's scenario number 2, what I'd call the mildly bullish scenario. Scenario number 3 is when things start to get a little more challenging. This would mean that instead of just the initial sell-off, we'll call that wave A, and instead of just being, and then this being a wave B to the peak that we saw in early September, this that we saw in the week after Labor Day is just the beginning of this big wave C downward. So it ends up being an A, B, C correction. I would say this correction actually doesn't stop at 4,300, but actually gets us right around to the 200-day moving average, if not a little lower. I would say the downside objective with the mildly bearish scenario takes us down to sort of that 4150 to 4200 range. We'd kind of be right around the 200-day moving average when we get to the end of October. We'd be talking about whether the market finds support there, whether there, what stocks have done what between here and there, and if there's further downside potential. Breadth conditions would be weakening quite a bit. In that scenario, higher rates probably remain elevated, if not accelerate further. Let's say the 10-year yield remains above 4.25, gets to 4.5%, and maybe even a little bit further as bonds sell off. Stocks, particularly growth stocks, struggle to mount any sort of upside movement with rates so high, and growth stocks just don't seem that attractive anymore. The pullback we've seen in Apple and Microsoft continues. And even though energy stocks in that scenario still may be okay, enough of the biggest names are struggling that it really drags the benchmarks lower. In this case, small caps most likely underperforming quite a bit. The NASDAQ certainly underperforming the S&P and the Dow, and it very much has a risk-off feel, although it's not the end of the world yet. We're still kind of around that 200-day moving average. This brings us to scenario 4, the very bearish or the super bearish scenario. In this case, this pullback is not just a pullback, it's a correction. The S&P gets to 4,200, gets to the 200-day moving average, and doesn't stop there. This would be a full risk-off scenario, meaning most likely growth stocks are not working. Energy, which has seen a bit of a breakout, probably fizzles out and doesn't make much more of an upside. Other cyclical sectors like industrials, financials really roll over, materials perhaps as well, and the only things that are working at all are purely defensive sectors. Sectors like utilities and real estate and consumer staples start to outperform, which they have not done at all really in 2023. So the very bearish scenario, we mean rates go up. Maybe economic data gets better and better over the next 6 weeks, and as a result, there's more and more talk of the Fed actually having additional rate hikes, and less about when they're going to ease monetary restrictions going into 2024. Those are the 4 scenarios as I see them. Scenario 1, the very bullish scenario. The S&P goes above 4,600, and we're talking about new all-time highs in the next 6 to 8 weeks. Scenario 2, the mildly bullish scenario. The S&P sort of is in that 4,300 to 4,600 range, kind of a time correction, not losing a lot of gain, but not really moving and recovering the pullback that we've seen so far. Scenario 3, the mildly bearish scenario would be we're down around the 200-day moving average, maybe 4,150, 4,200 or so. We maybe have not broken down much more than that, but it certainly is an ABC correction. It's a price correction, and things that have been rolling over, like Apple and Microsoft, continue to give up a lot more ground. Finally, scenario 4, the very bearish or the super bearish scenario. This is just the beginning. Everything starts to roll over, and the only thing you probably want to do is get super defensive, because at the end of October, we're talking about testing the October 22 lows. Which of those 4 scenarios do you see as the most likely, and why? Don't forget to leave a comment below. Let me know which one you select and why. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.